The S&P 500 has statistically appreciated at an average rate of 10% per year, but over the past couple years, our economy has gone through the ringer. So what can we expect it to produce in the next 5 to 10 years? In this video, I'm going to give you my thinking as far as where I think the S&P 500 will be by 2030, and then also some key metrics for you to pick out the best ETF or investment for you based on your goals. I'll also explain how I'm investing in anticipation for the rest of this year in 2023, because by the end of this year, I think things are going to get a little interesting. I'm Professor G, and I'm a real-life university professor, and I made this channel to make investing simplified. Now, you probably know that the S&P 500 is short for Standard & Poor's 500, and it was introduced in 1957 as a stock market index to track the value of 500 corporations that have their stocks listed on the New York Stock Exchange and the NASDAQ. The collection of stocks that make up the S&P 500 is designed to represent most of the composition of the US economy. And basically what that's saying is that with the S&P 500, you're basically investing and you get a small piece of 500 of the top US companies by market cap. Now, my favorite thing about the index and ETFs that are tracking the S&P 500 is that you can rest assured knowing that you don't have to do crazy research every single month on each individual company, knowing if you're gonna have to sell it because it's starting to do bad. If a certain company is doing bad for a certain amount of time, it gets kicked out of the index and they pull up a company that's been doing very good. One that's probably not even on your radar, but you get to be invested in it because you're invested in the S&P 500. So the actual companies that make up the S&P 500 will shift and will most likely look totally different 20 years from now than it does right now. And that's just the biggest reason why I think this is one of the strongest investments that you can have, because you know that you'll always be invested in the top 500 companies by market cap. For example, in the year 2000, the top 10 companies were, as you can see here, like General Electric, Intel, Cisco, Walmart, and AT&T. Now in 2023, the top 10 companies look totally different, with companies like Apple, Amazon, Nvidia, Google, and Meta. Side note here, a lot of people think that they can outsmart the market, or maybe they think this is just such a great strategy, and what they say is, since the S&P 500 is market cap weighted, it means that it's very much concentrated on those top 10 and definitely on the top 20 companies. That makes up a huge portion of the entire index. So why not just invest in those top 20 companies or something, rather than investing in the whole S&P 500? The problem is that yes, if you invest in just those top 20, maybe this year, maybe next year, you'll beat the S&P 500, but the problem is consistency, and the problem is long term. Just like I showed you before, if you thought that in 2000 and you just picked those 10 companies to invest in rather than the S&P 500, you'd have those 10 companies today most likely, and not companies like Apple or Amazon or Nvidia, huge companies that you would be missing out on just because you went with the ones that were the biggest at that time. So we know that owning the S&P 500 is a great move, and we know that statistically it's brought an average appreciation of 10% per year in the past, but what about moving forward? Right now we have crazy inflation, banks collapsing, unemployment rising, and it seems like bad news each day, with things like other countries not wanting to use the US dollar and possibly attacks or invasions threatening daily. Most are saying that we've never had a climate like we're seeing today, so these types of investments will definitely not do as well. Let's see. During the 2008 financial crisis and the Great Recession, the S&P 500 fell 56.8% from October 2007 to March 2009, but then recovered all of its losses by March 2013. In 2020, the coronavirus pandemic sent the world into a recession and equity markets reeling as the S&P 500 plummeted by 34%. The S&P 500 bounced back in the second half of 2020 and reached several all-time highs in 2021. So while I agree that we are in tough times right now and the rest of this year, maybe some of next year, is going to be dicey, I would disagree that this is anything new or that the market can't handle this correction. To figure out how much I believe the S&P 500 will be in a price prediction for around 2030, 2030, I need to introduce you to the rule of 72. And this is great because you can use this for any investment, whether it be an ETF or maybe even real estate. The rule of 72 is a simplified formula that calculates how long it'll take for an investment to double in value based on its rate of return. Basically what you do is you take the number 72 and you divide it by the expected rate of return. So in this case, we can generally expect 10% for the S&P 500. 72 divided by 10 equals 7.2. What this is saying is that it should take 7.2 years to double your money if there's an average of 10% appreciation over that time period. Now let's see if that's actually true, and let's look at prices of the S&P 500 back in history and see what's actually happened. And if I were just to pick one year, I'm sure that I would get accused of cherry picking the best year or something. So what I'm gonna do is I'm just gonna pick a random group of years, pick 3 different years in a row, average that out, and then pick something 7 years from then, average that out, and let's see what happened. From 1985 to 1987, the average price of the S&P 500 then was $236.74. From 1993 to 1995, the average price then was $484.58. That, my friends, is more than double within a 7-year period. But let's look at another group, maybe one more recent. From 2011 to 2013, the average price was $1,430.35. From 2018 to 2020, remember that 2020 was the year of the coronavirus shock and crazy market plummet, the average for those 3 years was $2,959.14. That's more than double too. So where do I think that the S&P 500 will be around the year 2030? Using the current data that we have right now, I've calculated that the average over the past 3 years, the S&P 500 has been around $4,134. Based off of this, I can confidently say that in 2030 or around that time, I expect the S&P 500 price to be over $8,000. Now, most of you are probably invested in an ETF that tracks the S&P 500, something like SPY or VOO. And so as far as price is concerned there, I would still say the same thing. VOO or VOO is currently at $378.48. And so I expect that price to be over $700 by 2030. Now ETFs and individual stocks do something called a stock split to keep the price down so it's easier for people to actually buy into. So it may not get to the actual price of $700, but the value of what that ETF will be at that time will be, in today's money, $700. In my educated opinion, not financial advice. What? So what am I doing with this info? While I wholeheartedly believe in these numbers and do think that it's going to double by that amount of time and will do what it's consistently done since about 1957, I also do believe that by the end of this year, we are going to see some market turbulence, and I think that the market could drop as much as 20% by the end of the year. Even knowing that, I'm still dollar cost averaging every 2 weeks into the S&P 500 and into other ETFs that I love. My favorites right now are VOO, SCHD, and QQQM. Right now I have about 75 to 80% of my investable money going towards those ETFs. The other 20 to 25% of that money that I would normally just be investing every 2 weeks, I'm putting that into a high yield savings account, letting it accumulate some interest. And at the end of the year, if things have dropped as much as I think, I'm going to throw all of that into the market. If things haven't dropped, then I'm still going to put all of that into the market, even if the prices are way higher than they are today. If you're wondering how you should be saving your money or allocating towards retirement or paying off debt and what order would serve you best, watch this video now.